There's no need to get up with the roosters to play farmland demand. Here are the best ways to invest in farmland without owning the land directly. Gladstone Land. The REIT owns farmland in 15 states. Exor. The holding company owns a big chunk of one of the largest agricultural equipment manufacturers. VanEck Agribusiness ETF. It invests in the major players in agriculture. Let's dive in. Here are the 3 ways to play the ongoing demand for farmland. Welcome to Timely Investment Research. Despite cooling inflation, investing in farmland remains an excellent way to hedge against higher prices. That's because it's a real asset that does well in periods of inflation and over more extended periods because of ongoing food scarcity issues. According to Barron's reporting, the 25-year average annual return for farmland through March 2021 was 11.2%, 160 basis points higher than the S&P 500. As they say about land, they're not making it anymore. And in the case of farmland, it's shrinking every year. For example, between 2002 and 2022, approximately 11 million acres were lost to development in the U.S. Add in the amount of food that will need to be produced in the next 30 years to meet the growing global population, and it seems unlikely that farmland will lose much of its value. Demand and increasing scarcity are a recipe for higher prices. One of the easiest farmland investment strategies involves buying stocks in agriculture-related businesses such as combine and tractor makers. While it's not betting on farmland directly, these companies are pulling for farmers to be successful because that leads to future equipment purchases. There are also some real estate investment trusts and exchange-traded funds that offer ways to play the farmland demand. Here are 3 of the best ways to invest in farmland without owning it. Number 1. Gladstone Land. Gladstone Land is a farmland real estate investment trust. It owns more than 115,000 acres of farmland across 15 U.S. states. The REIT's top 3 states for acreage are California, 34,844, Colorado, 32,773, and Florida, 22,606. In total, it owns 169 farms and 689 parcels of land. Gladstone Land, along with fellow REIT farmland partners, is the most direct way to own farmland other than to buy your own farm. Both REITs are valued between $500 million and $600 million, so it's a very intense competition. In 2023, Gladstone Land is down nearly 14%, while Farmland Partners is down around 9%. Gladstone has also underperformed Farmland Partners on a 1-year and 5-year basis. Yet, I like Gladstone Land because it focuses on family-owned farms and purchase prices between $2 million and $50 million, which is generally too small for most institutional investors. It structures the sales so the farmers can lease the land if they want or take shares in its operating partnership to provide for a tax-free exchange. Family farms are the lifeblood of U.S. agriculture, and Gladstone provides a way for farmers to exit with money in the bank. Since Gladstone's IPO in 2013, it's paid out $6.21 in total monthly distributions. It currently yields a healthy 3.5%. Number 2. Exor. In March 2022, I recommended automotive manufacturer Stellantis as one of 7 stocks to buy for the coming risk-on rally. I've been tempted to go with Exor, the Agnelli family's holding company. In addition to owning 14% of Stellantis, it also owns 26.9% of CNH Industrial, the maker of agricultural equipment under the Case and New Holland brands, hence CNH. In 2022, CNH Industrial accounted for nearly 17% of the holding company's gross asset value. While Exor only owns 27% of its equity, it holds 43% of the votes, giving it a strong voice in what happens to the company in the future. In the first quarter, CNH Industrial saw revenue increase 17% year over year, excluding currency fluctuations, to $5.34 billion. Adjusted net income of $475 million was 26% higher compared with a year earlier. For 2023, it expects sales to increase by 9.5% at the midpoint of its guidance and free cash flow of $1.4 billion. By buying Exor, you're getting exposure to CNH Industrial as well as a diversified portfolio of investments beyond agriculture. Number 3. VanEck Agribusiness ETF. The last way to play farmland demand is to buy many agriculture-related companies through the VanEck Agribusiness ETF. It tracks the performance of the MVI's Global Agribusiness Index. VanEck Agribusiness ED's top 10 holdings include CNH Industrial in the 8th position with a 3.65% weighting. Its larger competitor, Deere & Co., is the third largest holding at 7.45%. Other names include Zoetis, which develops animal health products for companion and work animals, and Corteva, an agricultural chemical and seed company. Since its inception in August 2007, VanEck Agribusiness ETF has delivered an annualized total return of 6.43% through April 30th. If you're the type that likes to invest beyond America's borders, you ought to pick VanEck Agribusiness ETF. Of the $1.1 billion in net assets, a little more than 52% is invested in the U.S., with the rest in places like Germany, Canada, China, and other countries with strong agricultural economies. Finally, VanEck Agribusiness ETF yields a reasonable 2.2%. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.